Good morning, everyone. Let me welcome you to today's Global Markets Call. For FX Markets coverage, we are starting with John Hardy.
Morning, everyone. John Hardy here. Sorry about that. We got some technical difficulties. Starting off, we've got a new key event slide. This upper portion you recognize from our previous morning meetings with today's events over this week or the next week if it's a Friday. And we've put some longer-term risks on as well, just for overview of what's coming up in the way of event risks. So do keep in mind, we have, of course, the non-farm payrolls change today and average hourly earnings. Looking recently near the highs of the cycle, just under 3%, and widely seen these average hour earnings is actually understating the rate of wage growth in the U.S. So still, if these are above expectations, I think it's one of those inflationary signals that bears watching. We just touched 2.5% on the U.S. 10-year yield, or very close to it yesterday. Those big round yield levels are very interesting and have been a key driver of especially dollar yen, although the dollar itself has been a bit sideways lately, especially this week with the euro. And then, of course, we have the Italian referendum on Sunday, key event risk there, and 3 pretty big central bank meetings next week. The ECB quite large, especially given the stories yesterday from Reuters that suggests, quoting ECB sources, that the ECB will be looking at extending the program somewhat because of obvious political risks coming up in the pipeline, but will also signal that they're eventually going to end the QE program, and that combination is euro supportive as it keeps perhaps the sovereign bond market orderly, while suggesting on the more hawkish side that eventually does have to be wound down. So going into the Italian referendum, we have Eurodollar actually towards 2-week highs. A bit interesting that that's the case given the level of nervousness in the options market. 1-week volatility close to where it was at Brexit. Just in pips terms, at the money, puts and calls cost 70 plus pips for a Monday expiry. So that's the kind of volatility we're potentially looking at. Other action in the Forex market, CAD and NOK have been strong with a correlation with the big oil rise. NOK Stocky and Aussie CAD have been interesting crosses on that account. So we highlighted Aussie CAD, that's continuing lower, 200-day moving average in play there. Sterling, we saw a hand reversal in Euro Sterling on the ECB story. And cable rally stopped right at this 126.75 resistance or thereabouts. That's a key level, the last sort of level above, until the 128 post-Brexit initial low. Briefly, and I'm sure Michael will talk more about this, we have seen this in white, the spread between the German 10-year and the BTP, the Italian 10-year, narrowing from well above 180, 180 pips down to below 170. A bit interestingly to me, a lot of this has been driven by actually a rise in Bund yields, more so than a notable improvement in BTP yields. But keep an eye on this as a coincident indicator and the degree to which concerns about the Italian sovereigns and thus the Italian banking sector are driving things. Finally, if we do get a very strong U.S. Data today and we see treasuries and yields going higher, and treasuries going down and yields going higher in the U.S., a big cycle area is going to be towards 115.50 plus. Top of the Ichimoku cloud, we have a big Fibonacci retracement level around there. So that would be, I think, a major objective. And then in the next couple of weeks, if we're out of the cloud, we're basically looking at that. This becoming support down on 112. But keep in mind this kind of level 115.50 plus $4 yen if it picks up the rally once again. That's it for me. I will pass it along. Thanks.
Thank you, John. Peter here on Equities. So very interesting day, as John also alluded to yesterday, with massive moves in U.S. fixed income and especially long-dated 30-year plus treasuries declined very significantly. You also had decline among energy companies, despite Brent and WTI still continue to go higher. Tech stocks also took a beating, and financials were sort of the outlier, still going higher on the interest rate expectations. As John said, the non-farm payrolls is definitely a green light, and also recent macro for a rate hike in December, I think, is 100% given. Italian referendum obviously key, as alluded to yesterday. I think, and John also said it with the bond spread, but I'm looking through the UniCredit share price, which again rose yesterday. It seems like there's a lot of informal traders are actually betting on a yes. And as I said yesterday, my take is that if you look at valuations and you actually look at the underlying surprise index on macro in Europe, it should suggest that European equities should trade higher, especially given the rally we have seen in global equities since Trump's victory, but it hasn't happened. And I think actually if we can get the Italian referendum key risk out of the way with a yes, I think Europe over the next 6 months, it will be one of the best performing equity markets on a relative, also an absolute basis. And you should be long, and especially the cyclical ones, and especially financials. So there will be a lot of interesting action and opportunities on Monday's trading. And then also I want to like to highlight a trade idea. I'll write a little bit more about it on Trading Floor today, the more details on it. But that's Capita, which is a British company. It has the lowest valuation in more than 15 years. It is down 50% from Q3, where it issued a profit warning, and there is a slowdown in the growth. But it's a company that is also seeing its lowest return on invested capital in 15 years, but it's still producing an okay profit spread. The growth is still decent, and it's a very stable business with also a very stable free cash flow. So I think, and the net debt situation is not terrifying yet. So I think the market is getting a little bit ahead of itself here, and I think it's actually quite an interesting opportunity. And I see around 50% upside over the next 12 months as the business stabilizes, and there will be a capital markets day here in December where they were actually highlighting some of their outlook, and expectation is actually set up such that if they actually just keep their current outlook, it could mean that this stock could go higher. So I think it's interesting. You can see the parameters for the trade, but I'll put a little bit more details on the actual trade idea on Trading Floor. But I think this one really looks interesting for the risk-taking long-term investor here. So there's an idea for today, and safe trading out there. And we have futures in the DAX a little bit lower, but nothing major so far. Thank you very much.
All right. Good morning, everyone. Certainly a lot of interesting action in fixed income markets at the moment. So I've got a pretty busy slide here. I'll try and navigate you through it. The Reuters report that John mentioned from last night. Apparently, if we have to take all these reports at face value, the ECB is now officially guiding the markets through Reuters news flashes. It seems. But this latest report here is a bit more down my line of thought. As I've mentioned before, I think the big black swan event in European fixed income next year is that the ECB could introduce some sort of QE taper, and this is what this report suggests. I don't think that is. I think that's very underpriced at these levels still. Specifically, what is said in this to be considered in this report is an extension at this upcoming December meeting. But at the same time, some sort of signal that the QE would eventually end. Surprise, I guess. But some parts of this report also indicates that they could be considering extending it at a lower pace, which would be quite a surprise to the market, I think, if that happens. If we look at the price action from yesterday and this morning. Markets already very much under pressure by the government bond markets very much under pressure from the recent oil rally and some solid numbers as well. But this latest ECB report took bunds all the way down below the 160 mark. We're still trading below 160, or actually we're trading right at 160 this very moment, and the 10-year yield at 36 basis points. Now, as John mentioned, a similar reaction in the US with the Treasury, 10-year Treasury just touching the 250, but quite a bit below now, 6 basis points lower at 2.44. Italy, the clear market outperformer in these few days leading up to the referendum on Sunday. The feeling is still that no vote is the most likely outcome, but it seems like everyone has figured that out. So maybe there's some advanced buy the rumor, sell the fact going on. Or in this case, it would be the other way around. Actually, it would be sell the rumor and buy the fact, which has also been the winning recipe at both Brexit and Trump elections. So I wouldn't be surprised if, even if there was a no vote, that the early Monday morning reaction would be another one of these probably short-term buying opportunities. The main or the worst performing area following this yield jump has been emerging markets, and we've seen some renewed concerns. I've shown the credit default swap spreads for Brazil and Argentina, some of the markets that, or some of the countries that I think are particularly interesting. We see both Brazil and Argentina risk spiking a bit here, obviously because of the US dollar debt concerns. But you get 5.5% on the 10-year Brazil US dollar bond at the moment, and for Argentina you can find 7.5% on the 10-year bond at the moment. So definitely some risk being priced in there, and we are getting closer to a point, I think, where that seems or could be compelling to take advantage of. But plenty of stuff to look out for the rest of this day, ahead of the weekend as well. A lot of key events coming up. So I'll leave you to that, end it here, and thanks for tuning in to the morning call this morning.
Thank you, Michael. Thank you all for taking the time and participating today. On Monday, we are back again at 8:40 CET. Thank you. Have a nice day.